Let's bust some myths. Full documentation versus lease documentation. A very common myth between these two different product types is the interest rate. A lot of people believe that full documentation loans can be cheaper or sometimes more expensive than lease documentation. Now, whilst there sometimes can be a difference, depending on the risk and how the banks price the facilities, normally the rates are relatively similar. There's no additional fees, generally speaking, for lease doc versus full doc. So it's very important to keep in mind that when we're looking to acquire a commercial property, rather than focusing on do we do it full doc or do we do it lease doc, we should be focusing on our end goal and which type of assessment process is best suited for our longer term growth. Syndication in commercial property. How is it structured and how do we put it together? First of all, syndication is when two or more parties come together, they have a little bit of money and they'd like to combine it to go and buy a property. Sometimes you see very large syndicates with maybe 20 to 30 investors, and sometimes it can be as little as 3 to 4 mates that want to go and buy a property together, something bigger than what they could probably acquire if they were on their own. Now, the way that we can look at it, if the loan is over a certain limit, we can look at the facility as what we call non-recourse. And that's where we don't use director guarantees and we're just looking at the net income for the property and how well it covers the loan. Now, it's not necessarily a lease doc loan. It's still technically in some instances a full doc assessment. And all that means is that rather looking at the ICR of the property like we would in lease doc, we'd be looking at the DSCR, so the debt service coverage ratio, how much the income covers the repayments as if the loan was principal and interest. Now, that doesn't mean we have to do principal and interest. The loan will most likely be interest only. However, when we're calculating the serviceability, if we're not taking directors' guarantees, we need to be a little bit more conservative than if we were taking directors' guarantees. Now, when it comes to syndication, a lot of people bring in the idea of using self-managed super funds because self-managed super funds can be a very big store of wealth. There could be a lot of liquid capital that could be put into these syndications to go and buy larger commercial assets. That is possible. Generally, the rules are no one self-managed super fund can own more than 50% of the units within the syndication, and we need to ensure that we know who the super funds are. So for most of these syndication loans, whilst we're not necessarily taking directors' guarantees, there's still a certain level of disclosure of the involved parties to meet the AML and CTF requirement. Now, when we're looking at the serviceability for one of these loans, if self-managed super funds are involved, we do not consider any contributions to the self-managed super funds. We're purely still looking at the serviceability as if it's just the property. If we wanted to look at the serviceability and use more than the property income, then we would generally involve some kind of charge or guarantee to ensure that that income source is captured within the loan facility and there's less chance of that income source stalling in the future. That's coming more into the term of a full doc loan, for example. Now, not legal advice, but one of the common structures that a lot of people use for these syndicates are unit trusts, and that allows us to see very clearly who owns what units and what percentage ownership they have. And when it comes to individuals and other related entities, there's no minimum or maximum number of units or percentage of units that they can own. That rule only applies for self-managed super funds. Now, the entry point for syndication loans is a little bit higher than some other types of facilities. If we're looking for full non-recourse, the minimum loan size is normally 2 to 3 million. Once we're at 2 to 3 million, above that amount, there are no further restrictions. We're looking at the net income from the property to help service these loans. And what that essentially means is that if the property is under-rented, or you're looking to do a rental reversion strategy, your LVR might be quite low. So if the property only yields maybe 3 to 4%, you might only be looking at a 30 maybe to 40% LVR. If the property is yielding more like 7 to 8%, net yield, then you might be closer to 65 or 70 and we'll be getting close to hitting the policy restriction. Now, in the event that you find a property, and let's say the yield is 10% net yield for your commercial asset, in most instances, that's going to service more than what the debt would be on the property at the maximum LVR level. And what that means is that even if your property could service a loan at 100%, banks won't always give you a loan for that level of LVR. They're still going to bring you back if that is the sole security, so the maximum amount they're willing to lend on that asset. Some of the other things that may change when looking at these particular assets, and especially commercial property, is the specialisation of the commercial asset. And what I mean by that is childcare centres, petrol stations and some other assets can sometimes be classed as specialised because in the event that the premises becomes vacant, you have to put the same type of operator back in there. Petrol stations are a very good example. petrol station can always be a petrol station. It can't be a warehouse one day, petrol station for the next tenant, and then something different for the next tenant. Whereas something potentially as a warehouse is a vacant space, same with retail, as long as it's not fitted out a certain way. That could be a hairdresser one day, a restaurant the next day, and that can keep changing as long as the premises allows for that. So warehouses, retail, and some other types of properties would be classed as non-specialised, and therefore they may have a higher LVR limit than properties that would be specialised. Specialised assets, generally speaking, may be motels, petrol stations, childcare centres, and other similar things like that. Now, that doesn't mean that we have to rule those assets out completely. It just means that we have to use a potentially different set of lenders than what we used originally when we're looking at some of the other properties. Now, that's primarily due to the security risk. Some lenders like a certain level of exposure to a certain asset class, and once we exceed that level of exposure, or that lender in their book, loan book, has exceeded the level of exposure that they're happy with for, let's say, retail property, then that lender may not push LVR as high as they used to for that same type of asset. Now, the main things to think about when considering a syndication is there's generally no formal pre-approval process. There can be certain documents that we can gather and put together, and we also have internal calculators that can assist you to tell you how much you can borrow against certain assets. The main thing to remember when shopping for any commercial property, especially when it's syndicate and there's multiple people involved, is that if we're borrowing money, we need to make sure that we have a good amount of finance period. The most common finance periods that we've seen after financing more than 100 commercial properties is 21 to 30 days. Now, sometimes that can go longer, sometimes shorter, but it's important to make sure that your terms are correct. If you need assistance with due diligence, there are also partners out there, such as certain buyers agencies and other firms, that can assist you in reviewing some of the information.